it gets a little bit more trickier. A company buys $100 worth of inventory for products it will sell next month. So the key here is that it just purchased inventory, and the act of purchasing inventory by itself does not lead to actual expenses. Rather, these purchases, they're going to be recognized as expense when these inventories are sold at some point of time, and that is called the matching principles. So here in this case, cash has been consumed. There has been a cash outflow from the cash flow statement, but there are no changes to the income statement. So no changes to the income statement. So cash flow statement has, it's starting from zero. However, as I told you, there has been a $100 cash outflow in cash. And now this time we have to make adjustments. Is this a difference? So it's a difference from purchasing inventory. So we know what to write. But is this a difference from operations or investing, or is it a difference from financing? Clearly it's a difference from operations. So we write under cash flow from operations, there has been an increase in inventory. And remember, an increase in assets usually creates an outflow of cash flow. So we write minus $100 on the cash flow statement. And it matches because we started from $0 of net income. We made a 100 minus adjustment. And at the end, cash in the end decreased by $100. So it matches. Changes in cash are going to affect year-end cash balances on the balance sheet. So cash will be decreased by $100, which will be replaced to inventory. So cash decreased will be offset by an increase in inventory, and the asset side will stay the same. No changes to the liabilities and equity side. So the balance sheet, in the end, assets going to equal liabilities plus equity. So to sum up, no changes in the income statement. In the cash flow statement, the 100 inventory increase reduces the company's cash flow. So cash at the bottom is down by 100. Cash is down by 100, but inventory is up by 100, so the asset side does not change, and the same for the liabilities and equity side. And the balance sheet now matches. However, what's going to happen when the company in the previous question sells the product for $200 in the same year? So temporary differences can be reversed at some point of time, and this is, I think, one of the most common reversals in daily operations. Now this time, because the company has sold the product for $200, clearly $200 will be recognized in revenue. And in addition to that, $100 is going to be recognized as cost of goods sold. The $100 of inventory that the company has purchased in the previous question. And now the company has finally made some type of profit. So operating profit would be up by 100, earnings before taxes will be up by 100, and assuming no taxes, net income will also be up by 100. So we use our formula again, and the cash flow statement will start from positive $100, and the retained earnings account will be increased by 100. And assuming the company has actually collected the $200 worth cash from the revenue, so actually there's going to be a $200 cash inflow. And again, it does not match. We start from 100, it ends at 200. We need some kind of adjustment. Where are we going to make that adjustment? Is it a difference from operations, investing, or financing? Is it different from operations? So we technically write decrease in inventory. And because of the decrease in assets, it's an inflow of cash flow. So $100 inflow of cash flow adjustment is going to be made, and the cash flow statement now equals. Changes in cash was 200, will affect year-end cash balances by $200. And because now we have consumed our inventory, we have used up our inventory. Inventory balances will decrease by $100, and we can now see the balance sheet matches. So in the end, there has been a $100 increase in total assets and a $100 increase in liabilities and equity. We can see that through these two transactions, the company has grown. The company size, whether you can see from the asset side or the total equity side, the company's size has grown $100. So to sum up, revenue is up by $200. However, cost of goods sold is up by $100. So pre-tax income and net income is up by $100, assuming no tax. Net income is up by $100, but cash worth $200 has been received, and we are assuming that no accounts receivables or something like that. Adjustments are going to be made for decreases in inventory. Cash is up by, actually this is typo, it's up by $200, and inventory returns to its original level. So the asset side is up by 100, the liabilities and equity side also by 100.